Hi there folks, now this week's video, bit of a sequel to last week's very popular video that I put out. You may have seen it. It's basically how to stop trading the Forex market if you're a Forex loser. Very popular. I think we've got about 55,000 views in the week. But I thought it was a bit unfair to just leave you hanging like that. So today I want to focus on how to become a Forex winner. But one thing that did strike me, because I signed up for a couple of demo accounts this week in the Forex market, is I'm not actually that surprised why there are so many losers out there. When you sign in to a MT4 brokerage account, the first thing that you get presented with can be quite daunting. So I signed up to a few demo accounts from different brokers, which is free to do, as you may well know. And the first thing that is presented to you, or the aspiring trader, is this page. I think they call it the market overview, pretty much standard for the MetaTrader program. You've got 4 charts normally, and there's so much information on there. Any untrained eye will look at that and think, wow, this is really complicated. I got lots to learn, all these bells and whistles that are going on here. There's so much to learn, and I've got to find in there somewhere the holy grail. Look up here. You go to the inserts here, indicators. There are so many different indicators. You've got trend following indicators. You've got all these oscillator indicators, MACDs, Forex Index. I've never even heard of them. D-marker, moving average oscillator, relative vigor index, the Williams percentage range. You can go to the custom ones, which you can buy off the internet somewhere. You've got the volume ones, on balance volume, money flow index, and trend as well. You've got the parabolic SAR, standard deviations. For anyone that's not familiar with Forex, they see this, no wonder they're going to be losing money, because they are overcomplicating things from the get-go. I say, if you want to be a Forex winner, ditch all that stuff and get down to basics. And that's exactly what I want to talk about in this video. So what we're going to do now is going to give you 5 simple steps that I think you should be doing if you want to give yourself half a chance at this business, which, if you know what you're doing, is not too complicated. It's all that nonsense you see earlier that makes things all that complicated. So the 5 steps. First of all, you've got to be realistic in what you want to get out of this. If you think you're going to come into Forex trading with $500 or $200 or even $1,000 to give up your day job, chances are you are going to be a Forex loser. You'll end up blowing out that account, refunding, blowing up, refunding, as that cycle goes on and on. You've got to be realistic with your expectations. What is realistic? Well, if you can achieve 3, 4, 5% a month, that's a really healthy target. Don't worry if you haven't got the funding at the moment to be a trader. If you've only got 500 spare capital in the world, it doesn't mean you should give up on the dream. There's plenty of ways that you can fund a successful trading career. And I'll talk about that in other videos, prop firm trading and the like. But don't be deterred because you haven't got the capital from the get-go. If that is you, don't be thinking about the money. Don't be thinking about the money from the get-go. Think about the process of becoming a trader. Then the money will follow you. Much more about that another time. So be realistic in your expectations. If you think you're going to give up your day job with a 500 account, trading just that, you're going to be a Forex loser. And you need to have a very simple price action strategy. All those indicators that I showed you a moment ago, they are basically taking their calculations from price, from the price action. They're just basically showing you price in a different way with different parameters that make you get into trades and get out of trades. But basically it all derives from price. So why don't we just crank it all back and just look at pure price and use our own brains to decide when the markets are going up and going down. In this video, I'm going to show you 3 simple strategies that you can use pure price action with to achieve some degree of trading success. Second thing you need to do, once you've got your strategy, and I'm going to show you 3, you need to backtest it. Now, backtesting is really, really important. I go on about it all the time. People that have been following me here for the years that I've been doing this will know that it's just basically something that I repeat over and over and over again. Backtest, backtest, backtest. Backtest, without going into too much detail, has 2 main purposes. First of all, to know if your strategy's got an edge, but secondly, to know how the strategy performs. so that nothing surprises you. It doesn't matter having a backtesting strategy and you might have 7, 8, 9 losing trades on the bounce. That's great if you know that over the period of time that ends up to be a strategy with a winning edge. But you've got to know everything about it. And the only way you know that is not by listening to me or listening to anyone else there on YouTube or whatever. It's by doing the work now. Backtesting, really, really important. Then you've got a demo trade. 2 schools of thought about that. Most educators out there, they will tell you don't demo trade. It doesn't have the same emotions as it does when you're trading real money. Here's my line of thought. If you can't make money in the demo market, you're certainly not going to make money in the live market. Now, I don't know for sure if you make money in the demo that you're going to make money in the live market, but I know the first is definitely the case. And if you believe what I said there in my first rule of trading about realistic expectations, then demo trading is so important, because you shouldn't be worried about that one particular trade. You shouldn't be getting emotionally involved. You're not thinking about the money. So why should you be emotionally involved in the real market or with the demo market? You shouldn't be, because it's not what you're focusing on at the moment. You're focusing on realistic expectations and going through this learning process. So demo trading is really important on the strategy that you have back tested to make sure that the rules are, of course, still aligning. And keeping a journal. Very important you keep a journal. Of course, losing trades, that means money is going out of your pocket. You understand that when you're losing, that's just a part of life. But get it into your journal so that the money spent on a losing trade, you learn by it. Did you break the rules? Is something going wrong? Only way of knowing that is if you keep a journal. I've talked about journaling before on many of my videos as well. Of course, you can always get in contact with me should you wish to. And here now, the 3 simple strategies that rely on pure price action. Now, I'm not going to go into the exact rules of engagement here. This is a methodology that I want you to think about. Next week's video, we are going to go through some exact rules of engagement. But of course, you need to watch next week's video for that. Make sure you subscribe to the channel if you don't already do so. That bell notification will let you know when that video comes out. All right, let's get on to it. Okay, it's going to rely on candlesticks. Candlesticks is pure price action. Again, I've covered candlesticks so many times, they're coming out of my ears. So I'm not going to go too much into them at the moment. Just a very brief lesson for those of you that don't follow candlesticks. Candlesticks basically show us 5 bits of information. They basically show us what happened to price in a given time period. This candle could be a 5-minute time period, it could be a 15-minute, it could be a daily, could be a weekly. It shows us who is winning the battle. Are the buyers in control or are the sellers in control? Very, very powerful. Don't need all those indicators. Everything is there on the candle. Here you'll see it's a green candle, which means it is a buyer's candle. It's a bullish candle. Shows you the price opened here. We hit a low down here on the wick and we closed higher than where it opened. Hence it is a green candle. This is a bullish candle. And of course, the same in reverse. Here you've got a red candle. This is a bearish candle. It shows you that the sellers are in control during that time period. Here we've opened up here. We hit a high up here with this high wick or shadow, whatever you wish to call it. Then the sellers come in to control, take control and push the price down lower. In this particular time period, we close down here. This is a bearish candle. The sellers are in control in that particular time period. So pure price action relies purely on candlesticks and some support and resistance and so forth. Okay, so what are we looking at? We're looking at 2 particular patterns. Again, I've spoken about this many times. I'm just going to skirt over it now so not to bore you all. Basically, we're looking at the bullish engulfer. We do not know when the markets are pulling back, whether it's a pullback or indeed it's going to be a reversal. Let's assume here we have an uptrending market, okay? And then we have this down candle. This basically will pull the market down, okay, in this particular time period. And then the next candle is a green candle, basically taking out the high of the previous candle. This shows you that this little action here, this bearish red candle, where the sellers are in control, they've been overpowered by the buyers and the trend wants to continue. This is a bullish engulfing pattern, often seen at key levels of support and resistance, can be very powerful. Opposite side of that is the bearish candle. Imagine you are in a downtrend, okay, and all trends, as you know, have pullbacks along the way, and you've got this little green candle now. This is the green candle. We don't know if that's going to be a full reversal or whether it's going to be a continuation of the trend to the downside. So we wait for the next candle and we see this red candle fully engulfing the previous candle. That shows you that these buyers that are in control, they've now been overpowered and price is heading down. So you've got the bullish engulfer, you've got the bearish engulfer, then of course you've got the bullish pin and the bearish pin. Bullish pin, here you've got the markets trading up, okay, trading up. Okay, then you have this big wick candle. Okay, so that means the sellers are in control. The sellers push the market down to a new low down here, but then the buyers come back in and push this price higher than where it opened up here. This is a bullish pin bar. This shows you that this little pullback here, that's basically been met with some buyers and we close higher than where we opened. Bullish. Doesn't matter about the color. It still shows you that the price has ended up at the top. This is bullish. It doesn't matter, I'll say, if it's green or red or what have you. It's still a bullish candle because the wicks creating these lows down here have been overpowered by buyers. And again, reversal to the downside, bearish pins. Okay, so here you've got a downtrending market. Okay, and then you have this pin that takes you higher. Okay, we don't know if it's going to be a reversal or it's going to be a pullback. Then the price is overpowered again by the sellers, hence the closing price down there for trend continuation down. That is a bearish pin. So simple price action to help us with our strategy development. And as I say, there are three main ways that you can use this simple price action in the development of a strategy. Again, we'll be talking about that next week. So you can use these patterns, these simple price action patterns, with trend following. Trends are here in the markets maybe 30-40% of the time, not always, but when they are, using these patterns can be very, very powerful. I'm going to whiz through this YouTube video, so I'm not going to go into all the different candles, but basically here you see here, markets are trending up. You have this pullback into the trend. Is this going to be a reversal? Or is it going to continue with the trend? Well, we'll wait for the next candle. It's a bullish candle. It's taking out the previous candle. That is an indication that this trend wants to continue. Okay, that's the bullish pin bar following a trend to the upside. Here you've got the bullish, that's the bullish engulfer, I should say, following trend to the upside. Here is the bullish pin bar. Trend is still going up. We have this little retracement here. The sellers are in control. Then the buyers come back in. We've respected the trend and we've closed higher, putting in this bullish pin. That is a rule that basically says you can take this trend higher. And of course, when you're entering the trade, you'll have stops in as well. Typically, you may place the stops below where the pattern was, and profit targets would be factors of that risk. More about that again, as I talk about it next week. That, of course, is a bullish trend. Let's look at a bearish trend, exactly the same, but in reverse. We got here, we got a bearish trend. Okay, now we have a pullback into the moving averages. These moving averages could be, say, the 8, 13, 21, or what have you. And you have this bullish pullback into the moving averages. Is this going to be a reversal? Are we going to end up going back up here? Well, we'll see. Next candle, we engulf the bullish candle, indicating that that trend is now wanted to continue, that this little pullback is just a natural pullback that you see in trend formation for the trend to continue on down. Again, same thing with the bearish pin bar. Trend is down, moving averages are nicely fanned out, 8, 13, 21. We have this big wick shadow to the upside, buyers are in control, but they're overpowered and the trend looks like it wants to continue. That with the trend. One way of using these. Another way you can use these really powerful patterns is using reversals. It's my flagship strategy, the naked trading strategy. Here you see where trends are moving up. You've got a trend moving up here, what have you, and we'll see a nice uptrend. We come into a level of resistance. You see a breakout of the resistance line, and you think, oh, we're going up. But then the sellers, all the sellers up here, they've shown their hand, and we've pushed ourselves below the resistance line, indicating that that trend is now going to reverse, that all the sellers are coming in, all these people here taking their profits from these long positions are now taking the profits at resistance. So it's showing you that this resistance has been respected. It's a reversal pattern. Same on reverse. You've got the trend trading down, okay? Trend trading down. We've broken through the level of support, but we see through this level of support, buyers coming back into the market and pushing it higher. That's showing you down here that there are buyers. We don't know what's down there until price gets down there. That type of candle shows you exactly what's down there. There's buyers, indicating that this wants to reverse. back up to itself. So using these pin bars, bullish engulfers at support and resistance, very, very powerful. Of course, that was the pin bars, bullish engulfers, exactly the same. Lastly, look at ranging markets. Now, markets are, as I said, trending maybe 30% of the time. That means 70% of the time, they're not in trend, they're in range. Using these simple price action patterns can help you predict the turning points when markets are going to basically move back to the mean, move back to the average. Often an indication of ranging markets are the moving averages. It's about the only real indicator that I like to use. Basically shows us the average over different time periods. When you see the moving averages all bunched up like they are at the moment, that basically means the market is in range. In range doesn't mean the markets are not going to be moving. They'll still be moving maybe up and down, but in that range, but they keep moving back to the average price. When you see this, and you might see a candle like that, that is an indication that we're now going to start moving back to the mean. And of course, on the downside, you'll see it again break through the level of support and then back up to the mean as well. So these price action patterns, I'm just showing you the pin bars there, but the same for the engulfers. You can use these in all conditions in the markets. You can use them in trend, in counter trend, and in range. Now, what I want you to do between now and next week is spend some time looking at these price patterns. And next week, we're going to start talking about actual strategy. I'm going to jump onto the screens and actually show you these in real life and maybe put some rules to these as well. Rules that you need to go away and back test. Last week's video, it's had 55,000 views in just short 6 days. That basically means there's 55,000 people out there that watched me in the last week that are basically losing money in the markets. My job is to change that for you, to get you to think things differently. And that's exactly what we're going to be doing in this video and of course next week as well. If you like the video, give me a thumbs up, give me a thumbs down. If you didn't, don't forget to follow me here on the channel. And you need to hit that bell notification. That way, when I release the video next week, you'll be notified the moment it goes out and you can start working with your strategy development. Don't forget, you can follow us on all the socials as well. As you may know, we are now streaming live around the clock up to 7 times a day. We've got 2 new mentors in our team, joined our team from the US. So we're now fully covered around the 24-hour period. Live streaming where you can come in, interact with us, look at us trading the markets live, talking about the methodology and so forth of what makes a successful trader. You can take out a 7-day free trial. Just head over to forexsignals.com. You can interact with me personally as well. Let me know you've come from the channel and I'll roll out the red carpet for you as well. If that's not a thing, I'll certainly see you next week. In the meantime, have a good week.